Hello, this is Will Shire, and this webinar is being sponsored by Traders World Expo Online, and a shout out to Larry Jacobs for all the work he did putting it together. This webinar is going to be kept intentionally short, and I'm going to focus on just one of several methods of using historical market price structure instead of the more fashionable Fibonacci numbers to acquire highly accurate numbers where the market is most likely to pivot from. And when this webinar is over, I hope that I'll have piqued your interest enough in learning more of these types of market structure concepts. A quick nod to the CFTC, who would like us to remind you that commodities are volatile and they're highly leveraged. The leverage can work both for you and against you. That past performance is not necessarily indicative of future results, and you may not be able to mimic these yourself. In other words, if you're going to trade futures, put the big boy pants on. A little bit of background about who I am and the experience may explain and perhaps justify the conclusions I've come to about some concepts that you may be familiar with and those that I use instead. I've been at this quite a while. In fact, it's a bit more than 20 years, I'm embarrassed to say. I actually got started in 1978, and I began mentoring with a retiring floor trader from the cotton market who was a bright guy, full of great market savvy and witticism. I have a book on these concepts, Pivots, Patterns, and Intraday Swing Trades, that Wiley & Sons published. They also have a website, a companion website to the book, and the book gives you a passcode to enter it. And I have a lot of other webinars on that companion website with color examples of concepts from the book. I have a lot of original trade models outside of that and brand name concepts that I use in conjunction with the pivot exhaustion grid and structure that supports and underlies these concepts. The point is that I look for these to arrive in confluence at the right edge of my video screen in order to complete and mimic pre-designed, pre-exposed trade models, the point of which is to follow a trade plan. And my other webinars emphasize this a great deal, as does the book. I think it's the only way to be successful. I do have a track record on all this. Yes, I actually trade all this. It's time-stamped. All my trades are time-stamped in a real-time chat room, which we occasionally open to the public. Recently we haven't. It's been too busy using it as a tool for students. Those trades are time-stamped and go out into some server on the cloud somewhere, I know not where, and I can never get them back. But I publish those trades online every day in my blog and make a few comments as to whether or not I kept to my trade plan and where I think I failed it and where I think it could be improved. I do have an inclusive training course for all this with the concepts and the software it takes to use these kinds of trade models. In case you're interested, you can read about that online. I have a lot of student testimonials because I'm an approved vendor, educator for with Interactive Brokers, and I'm an approved partner for education with NinjaTrader.com, both of which I'm proud to be associated with. Market structure. What is it? There are a lot of concepts in market structure that are apart from some of the more glamorous things that have been touted and used more recently. Those things being Fibonacci, for instance, and market profile and Elliott wave. I'm sure those are all credible. Some of it may be sacred science for you. I have worked all of those intently and have come up dissatisfied with their results. So the concepts that I use in market structure are more old school. I combine those with a lot of other new school concepts, one of which is serial sequent method. But we're going to talk about a couple of these aspects to market structure today. In fact, we only have time to talk about two of them, but a short list of them can include the high-low breakout exhaustion. We'll talk about that one. An inverted retest, we'll explain what that means. The V-cup pivot support. The opening range. If you're not already using the opening range in futures trading, you're a bit behind the 8 ball already. The opening range, how to derive it and port it. It's basically a pit concept, of which there are little and diminishing existence at the present time. But how to port that and how to use it are in a couple of webinars I've already posted online. Some that are supported by NinjaTrader online are published on YouTube, and there's some on my webinar on my own website, and they're numbered from 1 to 4. And I think numbers 1 and 2 are talk about the opening range and how to derive it. Pivot ledge, original concept. Breakaway laps, my concept. Tick laps. Apex and center lines, all session trend lines, dynamic curves, the cup and the curves, and something everybody's familiar with, a gap close. We don't actually trade towards the gap close, but we bait the trap as opposed to trade the gap, and a definition of those two things can be gleaned and examined and exposed on webinar number 4 of my website. So let's begin. All session highs and lows. We're going to look specifically at using these in 2 ways, and they may not be the ways you're already using that. We're going to examine them as points of exhaustion with the expectation that they're actually broken, but then reverse. And we're going to examine them from the point of view of an inverted retest. And we'll explain what that means in a minute. What you see in front of you is sometimes referred to as a gap chart. It's RTH, regular trading hours only. And it's day session only, if any of those terms are more familiar to you. They do not include price action between yesterday's close and today's open. It's not that that price action in night session is not important. In fact, we're going to revert to that in a second in order to examine a particular concept. But in order for us to establish what the opening range is and the previous day's day session only high and low and previous sessions close, we need to use a gap chart. These are 3-minute bars, and this contract is the mini Russell, both of which are my preference. Not all the lines here come from day session only, and a couple of them are in fact ported from all session, this one and this one, and we'll talk about those in a second. The opening range is the bracket of these 2 yellow lines. All the lines are color-coded so that you can remember what they are easily in a simple mnemonic, childlike mnemonic device, memory device, all of which are contained in the book. But the simple one here is that the day begins with sunshine, so the opening range is bracketed in yellow. And a little hint about the opening range, it's the most important layer of support and resistance for the entire day. The date on this chart, which is, I noticed, just slightly off screen for you, is May 15th, just last Thursday, and I'm doing this over the weekend. I don't have to look far for these examples. They're here every day. And so now let's go to an all-session chart from which we derive a more complete picture of this concept to study the action of highs and lows. This is the same contract, the mini Russell, and that's the June contract. And we're scrolling back here to look at places where some other lows are derived from, because we want to carry that information out until such time that the market actually comes to those prices. So we carry forward all our lines from all session lows into the day session only lows to get a bigger, more complete picture of the highs and lows. The highs for the day session only and the highs for the all session only are almost never the same. But we can port them automatically. The chart you're looking at is in 60-minute bars. I don't trade in 60-minute bars. In fact, I don't actually look at this chart, but maybe once or twice during the day, because the lines that I have here are ported automatically into the day session only chart. NinjaTrader has a function for this. ValhallaFutures incorporates a few improvements, we think, to it, and we have one of our own. But you can port these lines simply by changing in the properties that they attach to not just the 60-minute frame that you see in front of you, but to all charts of the same contract. So that by applying that, this line will apply into the day session only chart. We add a feature called terminate if touched. We don't want to have to go back manually and do all this stuff manually. We got a little bit lazy. But that's not necessary for you. If you're willing to keep up with this, you can do all this by hand without any other additional programming. So in its simplest form, we're projecting all previous lows out into history. This one, for instance, once established, is projected out into history until such time that price meets it again. I don't just trade off new lows when they occur. I use it in conjunction with other things, such as a peak in the momentum and another structural concept. But this is very critical to understand, because most of the time, when highs and lows are broken, they are not successful breakout trades. They usually meet exhaustion in conjunction with a couple of other things we use in Confluence. And how I would play that is that I don't predict necessarily that it will be a successful breakout, or instead a point of exhaustion. I position for it. In which case, if momentum happens to be peaking and I have other structural information that says most likely the end of a trend coming down could end at the break of this low, I simply wait for it to break and then put buy stops above the low once it has broken, because there is such a strong propensity for lows to be exhaustion. If it does reverse thereafter, it can sweep me up with it, having placed buy stops above the low. You'll see this happen every day. Yes, I know. You've probably been taught never buy new lows, never sell new highs. Well, a floor trader would of course laugh at you at that. This is where they do most of their work. The less experienced trader will, having perhaps positioned long already, will complain that the traders or some group of manipulators knew where his stops were and consequently came and got him here. That's nonsense. No one knows where your stops are. That is, no one can see where your stops are. Your limit orders appear as market depth because they're placed and occur and reside on the CME servers, or the ICE servers, in this case, because the mini Russell is traded on the ICE exchange. But everyone knows where your stops are. They're below the lows and they're above the highs. Floor traders typically work these areas because when stops are run, there tends to be a vacuum and the market tends to be exhausted. As a corollary to a premise we use, we note that most of the money to be made in the markets is made at the places where most traders are being stopped out and proven wrong. So we seek to trade where most traders are being stopped out as well. And it's typical that traders are being stopped out below lows. Once positioned in a trade like this, I tend to exit fairly quickly. And the reason I do that is to pay for the trade with a partial exit of perhaps one or two contracts. It may be less than a point, at which place I can then put a stop loss for the remaining contract at about an equidistant in case this doesn't form a low here And if I get stopped out, I tend to get stopped out at net break even. If you examine a lot of the posting of my trade blog, you'll see trades in which I got stopped out at +7, -7, or +5, -5, and so forth. Because I can't always be right about the trade, but I'm trying to pay for the trade fairly quickly. And if I don't get stopped out there, if my momentum indicator and the other concepts of the trade plan did come together so that I had a trade entry to begin with, then the propensity is for the market to reverse, and then I'm able to trail any remaining contracts with a stop. A swing like this may be worth 5 or 6 points or more in the space of an hour. Remember, these are hourly bars. So a lot of 3-minute bar action can take place as it works its way up. Sometimes requires a bit of patience. But my objective for the first frame of the day, the first frame being from 9:30 cash opening to 11:15, it's an arbitrary number I call for the first frame of the day, is only 5 points in the mini Russell. And it's not usually difficult to achieve. Once a low is broken, a new low is obviously created. And we keep track of every new low because in the future it may serve exactly the same way. Without predicting, it may position us for exactly the same sort of trade in which, if broken, a sharp reaction may provide a trading opportunity. It may be that several lows provide this as a trend develops. And once again, notice the rule that you may be breaking. Yes, academically, one might argue, since this is a series of lower lows, I'm now in a downtrend. Well, if that's the case, imagine using this downtrend for price breaks and selling short below this low or below this low, and how disastrous that would have been. Often the definition of a trend is academic. And if you get hung up on that, you may be giving up some of the best opportunities of the day. Now, let's leave the concept of exhaustion for a moment, and let's look at the other phenomena that can happen with lows. After all, not every low broken will produce a reversal that's tradable. Some lows, in fact, don't have that kind of reaction. Some lows are broken cleanly. Here's a low in which had no reaction. A buy stops up here, sitting and waiting would be useless. Depending on how far they go down, I often will tick my buy stops lower and get them below this low. But at some point, 3, 4, 5 points below this low, there's no use chasing it down. I don't know how much farther it's going to go. At that point, a clean break has clearly been made. But now, this low, having been ignored, has another behavioral attribute associated with it. And that is, if retested with what we call an inverted retest, a low being tested not from above, a low being tested from below, a previously broken low being tested from below, becomes resistance and may afford me the opportunity to short on that retest to get in sync with a trend that I may not have anticipated or caught early on. Remember, these are 1-hour bars. It might have taken 30 minutes for this to work down and 30 minutes for this to work back up. By this time, a momentum indicator might have produced an overbought signal, just working its way from here to here. Remember, these are 3, 4, 5 point swings in the TF, and just catching a couple of these in the morning can produce a daily profit goal. A short taken here, as it turns out, would have produced a really nice trade as the market then receded. So, there are two concepts in which I focus on lows and highs. The initial one tends to be that breaking a new low, especially if there was a substantial trip to get there, is more likely to produce exhaustion and a subsequent reversal rather than a clean break and a continuance of the trend. The other is that when the trend and the low is broken cleanly, the market tends to remember that. It tends to leave somewhat of a scar. And coming back to it will usually mean that it now serves as resistance. With that in mind, let's scroll forward and go through other examples. We can go through them faster now, as long as you understand what the basic concepts are. You remember this low here? It goes back several months. Eventually the market was to make that low and to reach it again. Someplace out here in the future, when price was in a big decline. At which point the market takes these lows out and reverses. There's another one that appeared here as I scrolled forward. At which time the market reverses again. So making the trip can be very significant. But not knowing where these lows reside can mean a huge loss of opportunity. And notice getting to this low, the market had to break another low up here. And that break was a clean break. That is, it didn't have a big reaction back up. So we continue to monitor that line out into the future, because it may serve as a point in which we can sell. Now, these are hourly bars. Whole days may pass before these lines are actually ever hit again. And once they are, knowing where they are can help serve in establishing new trades. Most likely these are evening session bars in the middle of the night because they're so narrow and tend to price when price tends to wander. Notice that there are really no divisions here between sessions and no other information that we're using on this particular chart to port that information into our daily frame. We don't focus too much on all this trade activity. We're not trading at that hour. But we want the history of it to be projected out to our day session only charts so that we know what those lines mean. I'm now retracing to a previously broken low and retesting it where it's likely to be a form of resistance. Charting the history of broken lows, of retested lows, and lows and highs that are exhaustion often tell the story of the unfolding market from day to day. This kind of action can give you more trade opportunities that have nothing to do with anything else but the lows and highs. Fibonacci not really playing a part here. When lows are met, they often have reactions. Some of the actions may not be largely tradable. That's actually a 4-point swing. Remember, these are hourly bars, and some of them are. If you at least get enough of a reaction to get to a net break even, then you've positioned for a possible success. If not, then you get stopped out, probably with a minimum loss. Lines that are broken and have no reaction are important. Remember, we continue monitoring those. This one, retest, did not quite make it. This low did have a reaction, not a huge one. But remember, this line gets projected forward until it does have some significance. In the meantime, lots of other stuff may be going on. Highs that are broken, lows that have reactions, lows that are broken and produce exhaustions, highs that are broken and produced exhaustions, back and forth. A low coming from much earlier that's producing an exhaustion, a trip back up that the market remembers and eventually gets to a low that did not have a reaction and serves as resistance for a trade back down. Over and over and over again. So that this history, just on this simple concept, can provide extremely valuable trades. I don't just trade on highs and lows. I look for other confluence of indicators. But this one by itself can give you an important clue and contribute towards a trade plan that is comprised of confluence. that you can take at the right edge of your video screen without the trend prejudice that may be associated with it, and perhaps lead you to successful trades. At the moment this was happening, that looks like a pretty scary trade to sell short on. Remember, these are 60-minute bars, and a lot of other things may be occurring that give you the hint that exhaustion or resistance is going to be met there.